Over the past several years, the U.S. housing market has undergone a dramatic transformation, from one of the hottest markets in history, driven by ultra-low interest rates and pandemic-related demand surges, to a sector teetering under pressure from soaring borrowing costs. At the heart of this shift lies a phenomenon that's commanding increasing attention: the relentless rise in U.S. Treasury yields. As Treasury yields surge, mortgage rates, which closely track the 10-year Treasury, have escalated to levels not seen since before the 2008 financial crisis. This report analyzes how high Treasury yields are systematically destabilizing the housing market, affecting affordability, construction, sales, investment, and broader economic health. Treasury yields, the foundation of mortgage rate. U.S. Treasury yields, particularly the 10-year note, serve as a crucial benchmark for mortgage rates. They reflect investor sentiment around inflation, economic growth, and monetary policy. How the mechanism works: higher Treasury yields, right pointing arrow; higher mortgage rates, right pointing arrow; lower affordability and demand. The correlation is rooted in investor behavior. When Treasury yields rise, mortgage lenders must offer more attractive returns to investors who buy mortgage-backed securities, MBS. To remain competitive, lenders increase rates for borrowers, ultimately making home loans costlier. As of mid-2025, the 10-year Treasury yield has risen to over 4.7%, pushing the average 30-year fixed mortgage rate above 7.5%, compared to 2.65% in early 2021. Impact on housing affordability: the most immediate consequence of surging mortgage rates is the erosion of housing affordability. Key stats: a $400,000 home loan at 3% costs $1,686 per month, excluding taxes and insurance. At 7.5%, the same loan costs $2,796 per month, a 66% increase. Most American wages have not kept pace with inflation, leaving many unable to qualify for loans or meet monthly payments. According to Realtor.com, as of April 2025, housing affordability is at its worst level in over 2 decades, with fewer than 25% of listings deemed affordable for median-income households. First-time buyers, traditionally the lifeblood of demand, are especially impacted, with many forced to rent longer or abandon homeownership dreams altogether. Home sales and market activity: fewer qualified buyers naturally lead to reduced home sales. The National Association of Realtors, NAR, reported that existing home sales fell nearly 15% year-over-year in Q1 2025. Meanwhile, new home sales dropped 12%, and mortgage applications have plunged by over 20% compared to the same period last year. Notable trends: real estate agents report longer time on market. Sellers are offering price cuts and buyer incentives. Bidding wars, common during the 2020-2021 boom, have all but disappeared. High-cost metro areas like Los Angeles, San Francisco, and Boston are seeing the steepest sales declines, while even traditionally affordable markets are cooling rapidly. Brick construction slows and builder sentiment decline. Homebuilders are also feeling the pressure. Rising interest rates increase construction financing costs, reduce buyer demand, and heighten uncertainty, leading many builders to delay or cancel projects. According to the National Association of Home Builders, NAHB, builder confidence dropped to a 3-year low in May 2025. Housing starts declined by 9% year-over-year. Multifamily project cancellations surged due to investor withdrawal. While home prices remain elevated in some areas due to inventory constraints, the slowdown in construction may eventually lead to undersupply, even as prices soften. This mismatch risks creating long-term affordability and availability problems. Price corrections and market revaluation: so far, national home prices have been relatively stable, buoyed by low inventory. However, there's growing evidence of weakness beneath the surface. Insights from Capital Economics and Moody's: they forecast a 10 to 15% correction in national home prices if rates remain high through 2025. Multifamily properties have already dropped 9% in value from peak 2022 levels. In luxury markets, price cuts of 20 to 25% are becoming more common. This dynamic is especially alarming for homeowners who purchased during the pandemic boom at inflated prices. If prices fall enough, some may find themselves underwater, owing more on their mortgage than their home's market value. increasing the risk of foreclosure or default. Mortgage industry pressure and lending contraction. The broader mortgage ecosystem is also suffering. With fewer buyers and refinancers, mortgage lenders are experiencing reduced volumes and declining profitability. Developments include several regional lenders have shuttered or merged. Big banks like Wells Fargo and JP Morgan Chase are downsizing their mortgage divisions. Refinancing activity has dropped over 80% compared to 2021. The Federal Reserve, once a major buyer of MBS, has shifted to quantitative tightening, letting its holdings roll off without replacement, removing a critical source of liquidity from the market. Investor sentiment in housing stocks, real estate-related stocks and funds are underperforming. The iShares U.S. Home Construction ETF, ITB, has fallen over 14% in the past year, trailing the broader market. Real estate investment trusts, REITs, focused on residential properties have also lost ground due to expected rent compression and cap rate expansion. Trends among institutional investors: slower acquisition pace from major landlords like Blackstone and Invitation Homes. Increased interest in distressed properties and note purchases. Shift in focus from appreciation to cash flow and defensive positioning. Investment interest in housing has not disappeared, but high rates and uncertain pricing are forcing a reset of strategy. Macroeconomic implications: the housing market is a key driver of the U.S. economy, touching everything from construction and lending to retail and local government finance. A sustained slowdown poses serious macro risks. 1. Consumer spending. Home purchases often trigger additional spending on appliances, furniture, and remodeling. With sales down, ancillary sectors are feeling the pinch. 2. Labor market weakness. Housing-related jobs, including mortgage brokers, real estate agents, construction workers, and appraisers, are experiencing layoffs and hiring freezes. 3. Local government revenue. As home prices decline or stagnate, property tax revenues may falter, forcing spending cuts in public services. If high rates persist, some economists warn of a housing-led drag on GDP, similar to past real estate downturns. What's driving the surge in Treasury yields? Understanding why Treasury yields have risen is key to grasping the broader picture. 1. Persistent inflation. Despite Fed tightening, core inflation remains sticky, fueled by wage growth and supply-side constraints. Investors demand higher returns to offset inflation risk. 2. Fiscal deficits. The federal government's increasing spending and borrowing needs are flooding the market with new debt. More supply. Right pointing arrow. Lower bond prices. Right pointing arrow. Higher yields. 3. Reduced foreign buying. Traditional buyers like China and Japan have scaled back purchases due to geopolitical concerns and domestic priorities, reducing demand. 4. Fed quantitative tightening, QT. The Fed is allowing both Treasury and MBS holdings to mature without reinvestment, tightening liquidity and removing a key yield suppressor. Is there a way out? Some hope exists for eventual stabilization, but risks remain. Possible relief scenarios: a recession could cool inflation, prompting Fed rate cuts. Political pressure in an election year may encourage support for housing. A return of foreign investment could help absorb Treasury issuance and lower yields. Risks of continued pain: inflation may remain sticky. The Fed may stay hawkish to maintain credibility. Fiscal expansion shows no signs of restraint. While mortgage rates may eventually ease, the damage to affordability, pricing, and investor confidence could take years to unwind. Conclusion: surging Treasury yields are far more than a financial headline. They're a destabilizing force across the U.S. housing landscape. By lifting mortgage rates to unaffordable levels, they're pricing out buyers, depressing sales, reducing construction, and undermining investor confidence. If yields remain elevated, the housing market faces a prolonged period of correction and contraction. The ripple effects extend beyond homebuyers and sellers. They threaten labor markets, local governments, and the broader economic recovery. In essence, the housing market may be entering a new era, one defined not by exuberance and rapid appreciation, but by cautious recalibration, shaped by debt, inflation, and the long shadow of rising rates.